Dubai and Abu Dhabi are constantly grouped together as a single real estate market, and that is a fundamental mistake. If you analyze them as one, you will misprice your risk, misunderstand timing, and make wrong investment decisions. We're looking at two different economies, two different market cycles, and two completely different investment stories. One of the biggest mistakes I see investors make is applying the same logic to both cities. They are in completely different phases in a real estate cycle. Dubai is a mature global hub. Despite being at an all-time high, Dubai remains one of the most undervalued and affordable Tier 1 markets in the world. As of 2025, you're paying over $2,500 per square foot for a prime space in Manhattan or London. You can still secure a top-tier luxury in Dubai for around $800 to $900 per square foot, and with a broader market averaging below $500. This price gap exists because while global giants like New York and London have peaked after centuries of development, Dubai is just getting started. Think about the timeline. New York is a 400-old city. London has been a financial hub for nearly a millennium. In contrast, Dubai is only a 54-year-old city. Our real estate growth has only been truly in motion for the past 25 years, and our freehold market is only launched in 2002. That makes it a 23-year-old market. So we are in the early adulthood of the city's story. And when you realize that Dubai is currently only about 30% developed and 70% undeveloped, you understand the magnitude of what's coming. We aren't at the finish line. We are in a multi-decade expansion phase of infrastructure and capital appreciation. So the right question isn't whether we've missed the boat. It's whether you're ready for the next 20 years of growth and willing to stop listening to the misleading headlines and stop obsessing over daily or even monthly charts. To build a truly resilient portfolio, you have to look at the other half of the UAE story, Abu Dhabi. By contrast, it's a young, expanding freehold market. While Dubai has had decades of international ownership, Abu Dhabi freehold market effectively began in 2019. This 6-year-old market explains everything: why the supply behaves differently, why liquidity moves at a different pace, and why the future upside looks fundamentally different. Dubai today is one of the most liquid and fastest moving real estate markets on this planet. The numbers from the first half of 2025 proves it. Around 431 billion dirhams in total transaction value and over 125,000 transactions recorded in the first 6 months. That's insane and record-breaking. That's over 25% growth compared to the first half of 2024. This includes sales, mortgage, secondary market transactions, institutional activities as well. Dubai is operating at full velocity, but with that maturity comes a new reality: supply. Dubai currently has over 440,000 units under construction. This explains why the supply behaves differently, why liquidity behaves differently, why prices and exit reacts differently, and why the future upside looks very different. However, to read the market correctly, you must understand the justification behind this volume and growth. This supply isn't hitting a vacuum. It's being met by a population that just crossed 4 million, with over 200,000 new residents this year alone, and the tourism sector targeting over 22 million visitors annually. While this volume creates high liquidity and the potential for fast exits, it also introduces an intense competition. Dubai is no longer a beginner's market. It rewards those who understand cycle, micro-market timing, those who pick the right area for the right objective, and have logical expectations, timeline, and disciplined exit strategies. Now let's look at the capital. Abu Dhabi has transitioned from a conservative institutional base into an aggressive expansion mode. They are building infrastructure, demand, and lifestyle and momentum, which is exactly how most profitable real estate cycles begin. Today, Abu Dhabi is anchored by a vision that is fundamentally different from anywhere else in the region. We're seeing a massive concentration for the global global tourism and culture. You have Al Saadiyat Cultural District. This is the only place on earth where you'll find the Louvre and Zayed National Museum within a single square mile. Number 2, global entertainment. Yas Island is already a powerhouse with Ferrari World and the iconic Yas Marina and the Formula 1. And with the recent confirmation of Disney in Abu Dhabi and the world's second sphere, the capital is positioning itself as an undisputed entertainment leader in the Middle East. So if you think the news of Disney Abu Dhabi is just another headline, look at the data from Florida. Disney World in Florida generates over 40 billion for the economy. That single entity is responsible for 1 out of every 32 jobs in the entire state. When Disney arrived to Orlando, it didn't just build a park. It transformed the whole real estate market to one of the most valuable real estate hubs in America. Properties near Disney in Florida have seen a growth exceeding 360% over the years, with occupancy rates hitting all-time highs because the demand is constant year-round and global. Abu Dhabi is following the exact same blueprint by bringing in the world's most powerful money magnet, Disney and Sphere, into a market that is only just opening to freehold investors. They are engineering a massive surge in the long-term value. This isn't about a theme park, I promise you. It's about a global brand that brings millions of high-spending visitors, thousands of new jobs, and permanent increase in hospitality and real estate. This is why Abu Dhabi isn't just a city anymore. It's an institutional-grade investment engine. When you add a 10 billion infrastructure investment the government is pouring into a city through 2030, you realize that Abu Dhabi isn't growing. It's being engineered for long-term wealth preservation. But the vision doesn't stop at entertainment. It's backed by massive connectivity through a Etihad Rail project, which is now linking the entire UAE. Underpinning all of this is the stability of oil-backed strength and sovereign wealth. Abu Dhabi is backed by $6 trillion in reserves and $1.5 trillion in global assets, creating rare, low-risk environment for your capital. This is exactly what attracts patient money, institutional funds, and that big money and families who aren't here for a quick flip, but for long-term capital preservation and the exponential growth that follows a city's fundamental expansion. Now let's dive deep into the numbers, because this is exactly where the data turns into a cheat code. Dubai, over 440,000 units under construction. Abu Dhabi, around 42,000 units under construction. We're looking at 10 times difference in supply. In Abu Dhabi, the demand is so concentrated that projects are selling in a matter of hours. This is a clear indicator that the market is moving and it's warming up into a full growth phase. Liquidity is growing. Momentum is being built before steep growth, and that's the perfect chart to enter before the aggressive growth. Now let's break down the market performance. In the first half of 2025, Abu Dhabi recorded over 51 billion dirhams in transaction value with over 40,000 transactions, a 39% jump from last year. More importantly, 3.3 billion came from foreign direct investment and mortgages only at 19.3 billion dirhams, so over 60% of the transaction in cash, which is a very important point, proving that the liquidity is expanding. And then compared to 2024, this shows strong year-on-year growth, rising mortgage confidence, increasing foreign participation, and more liquidity and clear shift from stability to expansion. So it's not about which city is better. Both offer incredible opportunities. If you understand the why and fit it to your objective, you'll always win. So choose Dubai if you want high liquidity, global visibility, and the ability to move in and out of the market quickly. It's the king of the volume. And choose Abu Dhabi if you want to anchor your wealth into a market that will have steeper growth on the long term with higher downside protection and early stage pricing. My last advice would be the biggest mistake isn't about picking the wrong city, it's applying the wrong logic. Remember, markets don't reward hype, they reward cycle awareness, understanding of the fundamentals. And if you want to move past the noise and look for the actual data, you are in the right channel. And if you would like to connect with me, click the link down below and let's align your strategy with the right market cycle. Thank you for watching, and I'll see you in the next video.